So let's say you have some extra money sitting in a savings account and you want to invest in real estate. You don't necessarily want to buy a place to live in yourself because you may not be committed to living in a certain place. You don't know your long-term plans, or you just don't need too much for your current kind of living situation. If you're single and you want to live in a city and you don't necessarily want to buy a property in an urban core, you may want to consider investing in real estate instead. So when you buy a property and you're not living in it, it's considered an investment property. So what are the kind of pros and cons of this? One negative is that obtaining financing will be a little more difficult and expensive than obtaining financing for buying a house that you're going to live in yourself. Just some specifics. So we talked about DTI in the video that we did on real estate finance. So the DTI will include investment property debt service plus whatever your primary home cost is. So in the equation that we described in the previous video, DTI takes into account certain obligations you have, including your primary residence cost, car payments, all that kind of stuff. So the problem with kind of buying investment properties that you'll be double counting housing as your kind of financial obligation. You'll have to pay for both your primary residence where you live as well as the debt service for the investment property. So it's going to basically raise your DTI, and so you may not qualify for financing for investment property just because of this. And of course, this is especially true if you're trying to get conventional financing, because conventional financing just has more strict underwriting standards. Also, the loan to value, basically the amount of loan given a particular property purchase price that the bank is willing to finance, will be lower. So, for example, if you're trying to buy a $500,000 property, if it's a primary residence, the bank may give you 80% of that. So they'll give you 400K as a max LTV, loan to value. But for an investment property, they may only give you 70%. So you may only be able to get 350K. So this is 80% LTV. This is 70%. And so if you're buying a property for 500K, in in the case of the 80% LTV, you only need $100,000 of your own money. While in this case, if it's an investment property, you have to put a down payment of 150K. So that's kind of the difference, because again, lenders will not, oftentimes they'll go to a lower loan to value for an investment property. The interest rate is also going to be higher because investment properties are perceived to be more risky to a lender than a primary residence, because they assume that basically you'll fight harder to keep the house that you're living in if you're in kind of a difficult financial situation than an investment property. The interest rate is going to kind of reflect that additional risk. So while you may pay 3% for a primary residence, you may end up paying 3.5 or 3.75% for an investment property. So you'll end up paying more interest. Also, you'll have to manage the property. So this will include, if there's any repairs that need to be done, if there's any issues with the tenant not paying, even getting a tenant into the property in the first place. This is all going to require either your time, if you're going to do it yourself, meaning you'll have to dedicate time to spend on managing your property, or money in that you can hire a property manager. So it's going to cost you one way or the other. It's possible for you to self-manage, and this is especially true if you don't have that many units and you live close by. So if you're buying investment property, it may be worthwhile to search in your local area to a place where, if there's a minor repair, or if you needed to show the property to prospective tenants, that it was not too difficult to get there. Higher end investment properties are also easier to manage because you're likely going to have higher quality tenants. So you won't have as many issues with non-payment or just maybe disturbances, or just you'll have a higher quality kind of tenant living in a higher rent location. If the property is built in the last 20 or 30 years, you'll probably also have way less maintenance issues. So, these are kind of considerations. Maybe buying a investment property, which is a little more expensive, and you may not be getting as great of a return on from a kind of cash flow basis, but from a headache and hassle basis, it may be a better option. And even if the property is in a newer location or it's just in a better condition when you buy it, you'll have less ongoing costs for maintenance. Paying a property manager is typically around 5 to 15% of the gross rent, and it depends on the property type and location. So if you have a property kind of in a lower end neighborhood, the property management company will probably charge you more for a couple reasons. One, because the rent is lower, and so on a dollar basis, if it's a percentage, they'll have to charge you a higher percent to kind of earn the dollar amount that they want. And also, as I mentioned, a lower end area may just attract lower quality tenants who are, not going to maintain the properties well, potentially. Also, just higher turnover from non-payment, more issues to deal with. So, in order to attract a property manager to want to take that job on, which is going to require more of their time, you'll have to probably pay them more. And this 5 to 15% does not include a lease up fee. So the work to get a tenant in, marketing the property, screening tenants, taking applications, and all that, that is going to be an additional fee in addition to this ongoing 5 to 15% a month. Okay, so I also wanted to just talk about house hacking and other non-traditional real estate strategies. And these topics are kind of their own beast, and there's a lot of resources online if you want to kind of dig into the details of how to pull this stuff off on your own. But I just wanted to introduce these concepts to put them on your radar to maybe spark an interest in thinking about real estate kind of in an out of the box kind of way. So, house hacking, here's a common thing that people do. So, if you're a single person, you may be content just to live in a one bedroom apartment on your own and kind of, just keep it simple. What you could do if you want to invest in real estate and also reduce your housing expense is, and if you of course have the means and the financial capacity to do this, is to buy a house with extra rooms and rent the extra rooms out. So, you could buy a house with 4 bedrooms. You live in the master bedroom, and then you rent, 2 of the rooms out. Maybe you keep one as your office, you live in one, and then you have 2 rooms rented. And, maybe these 2 rented rooms will pay the majority or all of your expenses for owning the property. So you're basically living for free. Of course, you'll have roommates. And of course, you will have to have bought the property, financed it, accumulated the down payment, and you're of course responsible financially for the mortgage. But you could potentially offset the expenses and live for free yourself by renting the rooms out. So this is one strategy that people have done with success. If you don't want roommates, another similar strategy is to buy a multi-unit building. So you could buy a duplex, for example. So there's 2 units. So you live in one and you rent the other one out. So you won't technically have a roommate. You will just share the property kind of with another tenant or tenants, and that could also pay for some, or if you bought in the right area and at the right price, all of your housing expense. So or the majority of it. So it's this is also, but again, it's similarly to buying the house and renting the rooms. You'll have to be financially qualified to buy the duplex or triplex or whatever. You can basically get conventional financing up to 4 units. So if you buy up to a fourplex and you plan on living in one of them, you can still treat it as a residential property and get owner occupant financing. So it's a pretty good deal. So you could definitely, if you bought a 4 unit building, live in one, rent the other three out, and you're probably gonna have no living expense of your own. So another strategy. You could also buy a house and build an ADU, an accessory dwelling unit. And so you can basically, you buy a house, you build a little unit in the backyard, or you could convert the garage. And depending on, if you are by yourself, maybe you even live in the ADU and you rent the main house out. And in that way, you could maybe even make a slight profit. Of course, building the ADU is a project, that's going to require capital, but you basically turned a 1 unit property into a 2 unit property, and you live in one. So, this is another strategy that people can do. And I think this is, just given the cost of building an ADU, converting a garage is much more affordable. But if you're building the ADU, typically the numbers only work out if you live in kind of a higher end area, just given the cost of construction. Okay, so another strategy is short-term rentals. So you can basically buy an investment property, and instead of putting a long-term tenant, you can keep the property on Airbnb or VRBO, and basically, just have them on a short-term rental basis. And the apps will basically be your marketing method to attract short-term renters. There's a potential for higher income. So, if you do this right, if you buy in the right areas. So, for example, if you buy a property near a hospital, there's a big market of traveling nurses, and you could potentially get a nurse to rent your house out for a couple months while they're on contract and pay a above market rent because it's a short-term rental. Or if you live, like, let's say you have a house in South Lake Tahoe, even if you're just renting it on the weekends, you can earn, just given the per day rate, you can earn more than you would if you just rented the whole entire place out for to a long-term tenant. So, this strategy only works in certain areas and where the demand for short-term rentals is high. And it does require work both upfront in that, you have to furnish the unit. You oftentimes you have to put kind of nicer decorations to make the property attractive and to attract the higher kind of per day rates. And you have to kind of build up a profile on these apps to attract people to rent your place, because it is competitive. There's many people doing this. So if you want to be successful, you'll have to spend time on marketing and making your property look nice. And then there's ongoing work where these have to be cleaned. It's kind of like running a hotel. You have to have the place cleaned up after a guest leaves. You have to deal with guest issues, and then you have to manage bookings. So this is kind of the ongoing work. But you can definitely achieve a very outstanding result if you do this, in terms of cash flow. You can make a significant higher rate of return if you're willing to take on the work to do this. So it's a strategy that people have done successfully.